GST and related issues continue to be top of mind for every company and business in India. I just want to mention before I turn it over to Paku and thank Ketan is USIBC is collecting our submissions for the annual pre-budget memorandum. If you have not yet submitted your request on that, including anything related to GST, please reach out to me or your policy director and we'll take that into account. But turning now to the topic at hand, I want to thank Paku, Udayan, and Ketan and Company, who is one of the stalwart members of USIBC, a true supporter and knowledge partner for what we do. It allows all of our companies to be able to execute and develop policy in a much broader manner. And so I want to thank them for partnering with us today and putting on this program. I want to turn it over to my dear friend, Paku Khan from Ketan, to introduce Udayan and take it from here. Paku, thanks, and over to you.
Amy, thank you so much, and thank you and the U.S.-India Business Council, and most of all to our friends and colleagues in the audience. Thank you for joining us today. So we want to wish you a very warm welcome, and we hope that everybody is safe and sound. As Amy indicated, we're here to talk today about something called GST, Goods and Services Tax, and the related issues to the supply chain. One overview issue is we are recording this session and it's going to be rebroadcast in a couple of areas on the internet, so please do keep that in mind. Let me introduce our key speaker today, Udayan Chokshi. He's my partner in our Mumbai office. Udayan is a senior indirect tax professional and a practicing counsel and is a partner as I said, in Mumbai. He's been working in the tax domain for close to 20 years, and he's been recognized in the International Tax Review's listing of indirect tax leaders in India for the past 7 years. Udayan advises on all indirect taxes, including GST, pre-GST taxes, customs, and FTP, and trade remedial measures, and also represents clients in tax litigation. Udayan's area of focus is tax optimized supply chain, including valuation aspects across direct and indirect tax regulations. And he's also been actively involved in tax policy initiatives and has been part of representations made to the Indian government on a variety of tax matters. So Udayan's the gentleman on the left, and he's going to take you through most of the program. I'm the fellow on the right, Paku Khan. I'm actually based in the San Francisco Bay Area, where I serve as executive director and coordinating our U.S. desk operations, and I'm also a competition lawyer by trade. So this is clearly an area that I'm going to learn a lot from through Udayan's presentation. So let me just very quickly run you through today's outline of what Udayan's going to talk about. And ladies and gentlemen, please feel free to ask questions. We have a large amount to cover and we only have 60 minutes to do so. So we'll probably take your questions at the end if we have time. Worst case scenario, we'll email you a response, but please use the chat feature on your GoToWebinar console. So very quickly, Udayan's going to walk us through India's GST model. Next, the administrative setup of GST, something called advanced rulings. Hopefully it's a way forward in terms of getting guidance on issues. The dreaded tax audits and investigations, that's a subject that's near and dear to my heart too. Recovery actions and director liability. Idea for risk management and cash accretion, and Udayan explained to me that cash accretion means simply saving money. Recent developments in the GST arena, and then finally some of the practical issues that U.S. businesses are facing with respect to GST. So Udayan, over to you, please.
Thank you, Paku. Thank you, Amy, and thank you everyone for joining us today. As Paku said, I'm going to start by talking a little bit about the Indian GST model, and within that cover a couple of key concepts, because it's issues around those concepts which continue to sort of plague us today in terms of where the risks lie, and in some cases where we've started to see some litigation. So as you know, we brought in the GST in 2017 following a constitutional amendment which was landmark at that time, in the sense that it was the first step of sort of fiscal federalism between the center and states. Till then we had services taxed by the center, manufacture taxed by the center, and then sales taxed by the states. and therefore this was the first time we actually put all of this economic activity on under a single legislation and said that we call it a GST. In the dual model that we followed in India, we have a parallel levy by the center and state through this sort of fiscal federalism route. And we break transactions up into two types. So we have the intrastate transactions, which means where the goods and services don't actually move from one state to another, where we have a parallel levy of CGST and SGST, that's the central GST and the state GST. And when there is a movement across state borders, or in fact international borders, then we have what we call an IGST, or the integrated GST. Now, the sort of crux of it is that we wanted to do away with several of the definitional issues that was surrounding several of the litigations that we had under the erstwhile, the pre-GST law, in terms of what manufacturing activity was, what sale was, the fact that services got taxed later on, and the fact that there was a distinct overlap between what we call deemed sales, which were actually transactions of service, which had evolved through decisions of the Supreme Court. And, you know, the GST was supposed to solve all of those. However, when actually one looks at, you know, some of the definitions and the way these are being interpreted, we actually find that I think some fairly basic, you can say, gaps have remained in terms of, you know, the definition side of things. So if I were to just talk about the definition of services itself, it says that anything which is not a transaction in goods is a transaction of service. And we've had, therefore, questions being asked about, is a transaction in immovable property, which is clearly not a service, would that also be covered within services? And therefore, you know, we have this issue of what services should and shouldn't sort of cover. And if you look at that in the context of what, you know, international treatment of some of these transactions is, then you really see that probably the definition has, you know, fallen somewhere short in terms of what one might call international norm or international best practice. And let me take the two examples that I've put up on the screen. The first is how we treat the transfer of a business as a going concern, and this is key for all M&A activity. So whether it's, you know, through a business transfer agreement or, you know, any transactions, those type, what we call slump sales for income tax purposes, any of these M&A transactions, there's always been this issue of, is there going to be a GST? Is this going to be treated as a taxable supply for GST purposes? Now, in most other VAT or GST jurisdictions around the world, the treatment would be that this is a transaction excluded from the ambit of the levy altogether. But what we actually ended up, you know, defining it and placing it in the Indian legislation is to treat a transfer of business as a deemed sort of supply transaction. And then it becomes an exempt supply under, you know, the rate schedule that we have for it. And that actually gives a whole set of issues in terms of, do we need to make reversals of tax credit because that this gets treated as an exempt supply? So clearly there was intent, you know, to actually leave this out of tax, but given that this just followed on from how service tax treated these transactions, we actually ended up with what I see as a clear gap in terms of, you know, international best practice. Or take something emerging like cryptocurrency. We had a ruling of the Supreme Court on, you know, the validity of cryptocurrency, whether it, you know, it's allowed or not allowed in India under our RBI regulations, our Forex regulations, and so on. While, of course, the last word hasn't been heard on that, we are left today with a complete uncertainty in terms of, you know, whether crypto should be seen as a form of currency, whether it sort of meets the definition of money and therefore would fall outside the definition of goods and services, or because it has several of the attributes of goods, whether it should be seen as an intangible asset of some kind. So again, there's there's significant uncertainty around these aspects of definition. Moving to slightly more sort of conceptual issues, but again, key to the GST model, it's this issue of how do you determine situs for a goods transaction. And I want to take you to two recent examples in the context of intellectual property. So you all might have heard of the situation where Novartis was actually seeking to acquire a brand from overseas, and the question was whether, you know, there would be any tax on that. Now, while the Advanced Ruling Authority ultimately declined to give an answer saying that this was for the applicant, not for Novartis to file the advanced ruling, interestingly, what the government, that's the tax department, has put in their response to the advanced ruling is that they would like to treat the import of the brand as a transaction in goods and actually apply it with an incidence of IGST, sort of treating it as a levy of customs duty. Now, we know that for customs purposes, we don't tax intangibles. But like I said, given this gap in terms of how goods have been defined, we are in this position where the department's actually seeking to take this view. And sticking with brands, we have the Horlicks transaction where GSK transferred the Horlicks brand to Unilever. And there was this issue in terms of what the status of the brand is. So we're dealing here with a transaction between two multinationals. And yet we hear that there have been questions by the tax department saying that given there's the presence of this brand in India, the trademark being registered in India and so on, that there is an India tax footprint and therefore that it should suffer some tax. So this again arises out of this issue of status for goods transactions not being defined. So while we have detailed rules on place of supply, again, there's a bit of a gap here. Sticking with this issue of place of supply, we've had the issue of intermediary services. Now, this is an important sort of type of services for businesses, starting India operations. So quite often we start with an agency, and an intermediary would be sort of one form of that agency where you have a representative in India, perhaps arranging for transactions of goods and services, negotiating on behalf of the foreign principal, and so on. Now, the place of supply provisions, which for intermediary services, actually treats the service as being provided in India. So the place of supply is in India. And this was sought to be challenged before the High Court to say that, does this actually violate some key principles of indirect tax in terms of how services are to be treated? And are we not actually treating what is an exported service wrongly as a domestic transaction? Now, this came up before a bench of the Bombay High Court, where the two judges on the bench took actually differing views, and therefore the matter has now been referred to a larger bench. So again, like I said, a point of conceptual challenge where this issue of intermediary, and there are variations in terms of the intermediary model. And those of you who are dealing with sort of agents in India, some types of subcontract, all of these are business arrangements where this issue of how place of supply should be determined does come up. We also have another transaction type, which is before the courts, which is, should there be a reverse charge provision? That is, should there be a self-assessment by the service recipient in India when there is an import being made on CIF Incoterms? Now, we did have a ruling of the Gujarat High Court saying that this tax should not be payable, but this matter is now pending before the Supreme Court. And then, just to, before I sort of end on this subtopic, a couple of unresolved issues even 4 years into GST. The first is this issue of a deemed supply. Now, the deemed supply is a transaction where the two entities, or the two presences of a single entity in different states are deemed to be different persons, and therefore the transactions that they may have from one to the other, even though they don't pay for them being the same entity, are sought to be taxed under the deeming provision of Schedule 1. There was a draft circular that the Central Board of Indirect Taxes put out to say that these should be cross-charged and the manner in which they should be cross-charged. That draft circular never saw the light of day in terms of final version, and therefore there's two distinct sets of opinions in terms of whether there should be cross-charge or not. For those who are doing it, they're being asked questions about why they've done it. For those who haven't done it, they've been asked questions on why they haven't done it. So there is that uncertainty around how one should treat this deemed supply in the absence of consideration. Likewise, the issue of liquidated damages, it's been an old issue. It's been with us since service tax, but we haven't seen any specific clarification on it. And while the courts have actually settled it to say that there is no supply in a transaction of damages, we still have these matters being litigated in the courts, quite regularly.
So, Dan, before we get to the next section, and I know we don't have a lot of time, I did have one question. How's the government dealing with all of these unresolved issues, and are businesses actually approaching the government to deal with them in the 4 years since GST has been rolled out?
So Paku, yes, I mean, businesses have quite actively been taking this up. There are different forums before whom this is being taken up. There's, bodies, trade bodies in India, as well as international trade bodies, the likes of USIBC, all of whom are talking to the government about these. Like I said, several of these are issues which have continued from pre-GST days as well. We have seen some clarifications come through, but I think what we've tended to observe is that these clarifications don't actually go to the heart of the most complex questions. They tend to be a little simplistic, and therefore, while they might throw a little light on what the issue is, it's not really completely resolved. So all of the points that I've mentioned, these definitional issues and all of these issues that I've mentioned, really continue to be issues of some worry. And as we are now in the first round of audits for the 2017-18 financial year, we're actually seeing that the tax department's actually asking a lot of questions about them. So we don't really have a satisfactory answer. Is I think is really the situation.
All right, thank you.
So moving to the second bit, just wanted to talk a little bit about the administrative setup of GST, and I think that rolls up to the point that Paku just made, saying who's making the decisions for GST in India, and if there's something wrong, or if something, there's a policy decision that needs to be taken, what's the best way to go about doing it? So the apex body for decisions in GST is the GST Council. It's actually a body which gets its power from the Constitution itself. It has representatives from both state and center. So the chairperson of the council is the Union Finance Minister, and then you have the Ministers of Finance of the states, all representing the states on the body. Interestingly, what was discussed and what the Constitution says is that the decisions are to be made by a 75% majority. And if you see the weightage of the states and center, what that clearly means is that the states can't actually do anything on their own. They can't take a decision on their own. It has to be the center with the states. And we've seen over this 4.5-year journey, all of the initial meetings, every decision was being taken by consensus. And somewhere along the way, and I think that's been a point of concern for some, that this mindset of everything having to be by consensus has got diluted somewhere along the way. It possibly has been around the issues of compensation that the central government needs to give to the states for revenues that they've lost, that was promised to them when this move to GST happened. But today we're in a place where increasingly some key issues are at a deadlock. So the way it works is that you have to ultimately go to the council, and the council makes recommendations, and it's pursuant to those recommendations that Parliament changes its laws, and then the state legislatures change their laws. I also wanted to mention that there are a bunch of different committees which operate under the ambit of the GST Council. Key among those are the Law Committee and the Fitment Committee. The Law Committee's job, of course, is to make sure that the legislation moves in a manner keeping up with the requirement of sort of changing business times. We've seen several amendments to the legislation over this 4-year period. And of course, the Fitment Committee makes the news much more. The Fitment Committee has the job, it's represented by some of the states, senior officers of some of the states, not all of them, who have the job of making sure that things are being taxed at the correct rate. And as you would have been hearing, over the last several GST Council meetings, what's actually ended up happening is that we've had rates changing pretty much at every meeting. So the Fitment Committee has been busy, partly dealing with issues like inverted duty structures or situations where a concession has to be given for example, medication coming in for COVID treatments, things like that. But otherwise, the Fitment Committee has been, busy dealing with some very key definitional issues in terms of, how GST rates are determined. I'll come back to that a little later when I'm talking about some of the practical issues. So we have, therefore, the GST Council and these different committees, and therefore, if there's an issue to be addressed, it's really these committees who need to come on board first. It'll be through them that one gets to the council itself. There also are different groups of ministers who've been given sort of several specific and sort of specialized, responsibilities under this. What this means for advocacy is that, like I said, no decision is going to ultimately get taken without the central government being on board, and therefore, most of the time you need sort of a word at the CBIC, and of course, for several sort of situations, the states are also important, because there could be a state dimension in terms of, a particular item being important for a state. Take, for example, sort of petroleum products or ATF. The fact that, it's ultimately the key states for bringing ATF into the tax ambit would be the states where, most of the planes refuel, where the larger airports in India are. But neither the state nor the central government, for example, has wanted to move on that. There's a significant amount of tax being collected through petroleum products. These are being collected under the pre-GST taxes. And therefore, until the states and the relevant states and the center decide to move in tandem, we aren't actually going to see those changes come through. I also want to talk a little bit about the increasing role of courts in terms of, how the law on GST has evolved. And this is probably something that one wouldn't have expected to see in 2017 when the law was being set up. So I want to take you through to three actual examples. The first is advocacy efforts, which have been reinforced through writs. So we're actually representing a taxi company in India, and there was a question about what the correct rate of tax should be. And the advocacy effort there was to seek a clarification from the government. And when that wasn't forthcoming, what we actually did was approach one of the high courts, the Madras High Court in this case, and said to the Madras High Court that, in the absence of this clarification, we're actually having a divergence of positions across players in industry. Not only does it cause sort of uncertainty in terms of correct tax position, but also it causes takes away the level playing field. And the Madras High Court was quick to, pass an order asking the CBIC to put a clarification on this in place. The courts have also been quite active in challenges that assessors have made to the department. And quite honestly, any tax professional in India is quite shocked at the amount of litigation through writ petitions that have happened. So several aspects of department action which have been challenged in terms of, overreach or what is seen as department overreach. So whether it could be sort of arrest provisions, and of course we'll talk about that in more detail, provisional, attachment of properties which have happened, or other situations in terms of the implementation of the GST law itself. So for example, transitional credits. Now, it was a key element of the GST law to say that credits earned under the erstwhile VAT levy or the SENVAT levy, excise and service tax, would be migrated over. But for one or the other reason, we've had issues, technological, legal, interpretational, documentation, what have you, where sort of millions or billions of rupees, in fact, have actually been stuck in transitional credits. And several matters on issues like these are pending before the High Court, in some cases, the Supreme Court. So if I were to sort of, bunch them, I think there have been three distinct groups of these issues. So transitional credit clearly is one, and even 4 years into GST, we're fighting matters on transitional credits. The validity of certain provisions, especially things like refund provisions, inverted duty structure refund provisions, conditions that have been imposed in the rules which actually aren't enabled in the law itself, and technical glitches. Most surprisingly, we've had to move the courts to say that the system actually isn't delivering on, even when the taxpayer has done the right thing, the system isn't delivering on passing the data through. In fact, just yesterday, I think there was a Bombay High Court case saying you can't deny someone's refund because the customs database is not talking to the GST database. So we are dealing with these sort of issues.
Udayan, before we get to the next topic, when we were preparing for this, you had mentioned that the GST Council met for the first time since the pandemic began. So can you give our friends in the audience a little bit of guidance in terms of the key takeaways from that, and overall, what's the government outlook on GST? The other question I had was the importance of advocacy and practical tips to our audience on how there can be advocacy under this GST regime.
Right. So Paku, the last meeting, actually, the bulk of the discussions, the bulk of the conclusions were around tax rates. And if you see the editorials that we read after, or people in the tax fraternity were asked about their takeaways of the meeting, and several of them actually showed disappointment with this aspect, that a body as sort of high-powered as the GST Council, who should be looking at things, of a strategic nature, of a legislative nature, is actually doing stuff around sort of rates. And I think there were two other big misses in terms of these meetings. So I talked about petroleum products and ATF, but natural gas is the other candidate. That's an integral part of what is used. It's one of the fuel for several of Indian businesses. So both ATF and natural gas, we've been hearing every now and then that these need to come into the tax net. Maybe petrol, diesel, and so on may follow later, but again, there was no word on those. There was also a sort of miss in terms of, advanced rulings, and we'll talk about those in a minute. A process to actually, reconcile advanced rulings of different states, as well as the fact that there's no adequate appellate remedy at this time in India. So, for example, if you have an adverse ruling by the GST authority, the appellate tribunal is yet to be set up 4 years into GST, and therefore these are all matters which are going before the courts as well. So I think the main takeaway, like I said, from that last meeting, ultimately ended up being about rates. Of course, all of this has been taken up to the GST Council, and one would hope to see that will actually come through, in the meetings that follow. You mentioned about advocacy. I think that the takeaway on advocacy has been that certainly the rate changes have all been, pursuant to representations on why rates need to change. So it's not like the council isn't listening to these requests by industry. I think it's just a matter of several things have happened. We've had COVID, its effect on the economy, the fact that the revenue targets to be met, and why taxes are being kept high to actually keep those up. But it's not like advocacy isn't being taken care of. So I think at some level, there is I would say a reasonable amount of satisfaction that the government certainly listening to requests that are being made. I think where the dissatisfaction comes is in terms of translating that into actually changing the law quickly enough.
Thanks.
So let me just quickly talk about advanced rulings. I touched upon those before. Now, the advanced ruling, when it started, so we've had advanced rulings under indirect tax and direct taxes for several years now. And the purpose of advanced ruling was to say that let's get certainty on how a particular transaction is going to be taxed, how its taxability is going to be viewed by the department, and everyone move forward with that certainty. What we've seen in GST, however, has been an absolute deluge in terms of the number of advanced rulings that came through. And I'll come to the experience of what those have been. Now, the Advanced Ruling Authority, just to quickly recap, is actually a state-specific authority. So in each state, you have the Advanced Ruling Authority for that state, represented by officers both from the central government as well as the state government. So what you have there is actually 2 tax officers of a joint commissioner rank. You don't actually have the equivalent of a judicial member like you used to have otherwise in the Advanced Ruling Authority, and that could actually be one of the reasons why we've been seeing some of the outcomes that we have been. Now, having a separate authority for each state also means that you can potentially get different views, contrary rulings from these states, from different states, and that's actually been unfortunately the experience, and significant uncertainty for businesses coming out of the fact that the Advanced Ruling Authority of one state doesn't actually follow what happens in the other. As far as the experience of advanced rulings have gone, it's it's sort of tongue-in-cheek, but the phrase one hears is that it's not the Advanced Ruling Authority, it's the Adverse Ruling Authority, because pretty much every application that goes before the authority, if it's a choice of am I in the higher rate or the lower rate, it's almost inevitably the conclusion is going to be that you need to pay the higher rate. Or if it's a question on will I get tax credit or not, the answer is going to be no, you won't get tax credit. And let me take that sort of issue forward in terms of you've actually had contrary rulings also. And let me take 2 examples of those. One was in the context of solar EPC contracts. Now, the goods that go into solar EPC contracts are taxed at a lower rate of 5%, and several of the players in the industry went up to the advanced ruling authorities in different states to say that we set up these solar power plants, the goods are taxed at 5%. What's the correct rate? How do we sort of value the entirety of the EPC contract? And what several of the advanced ruling authorities held was that this is a works contract resulting in immovable property, and therefore, notwithstanding the 5% rate, it all needs to be taxed at the higher rate of 12%. You then have pretty much in the teeth of this sort of proposition, a ruling on the taxability of traffic systems, where when there was a higher rate in terms of the equipment going into the traffic systems being taxed at 18%, and when somebody wanted to say that, can we tax this at the lower rate of works contracts, we have a ruling saying that no, these are actually two separate contracts for goods and services, and therefore you need to tax the goods at the higher rate of 18%. So I think almost, it's, I think over 95% we've had adverse advance rulings, and therefore I think strategically, in fact, in several cases we're finding advisors tell clients not to actually perhaps approach the advance ruling. There are of course certain situations in which the advance ruling might be a good way forward, but if you have a debatable tax position, perhaps the best way to deal with the debatable tax position might be to either ask for a clarification, the type that I mentioned, by moving the courts, or perhaps to just go ahead, keep an opinion on file and then litigate the matter as and when it comes up. Paku, you wanted to...
If I can just quickly ask you a couple of questions on this. Given all these contradictory advance rulings, is it even advisable to seek an advance ruling at all? And the other thing, I just want to clarify one point. You mentioned the AARA, the Appellate Advance Ruling Authority. Am I understanding correctly that there's no appeal from a ruling by the AARA?
Right. So yes, Paku. So there is no appeal. So there is the appeal from the AAR. The Advanced Ruling Authority is to the appellate AAR, and yes, there's no appeal beyond that. However, in several cases, more for reasons of process, because the courts have said that it's not their job. There is no judicial review in that sense in terms of what the findings are. They are not actually a court of appeal for this, but there have been in several cases advance ruling matters successfully being taken up to the high courts on grounds of arbitrariness or how the decision has been come to, and therefore we are getting in several cases good relief from the high courts. And to your point, Paku, about does it still make sense to go to the Advanced Ruling Authority? I think two cases where it does make sense still is if you're looking for an expedited adjudication of the type that I mentioned, you're looking for clarity. Perhaps the quickest way to do it might be through advance ruling. The second is that it forms a useful tiebreaker, and I say this again, this will vary from a client to client situation. But if there is as a tiebreaker between, let's say, customer and vendor, in terms of what the correct tax position is, if what you're looking for is certainty, because in several cases, especially if there's going to be a tax credit available, if all you're looking for is certainty, then it might be a good idea to use the advanced ruling as a tiebreaker test. Okay. I think the final takeaway, and that's it's not on the tiebreaker point, but I think there is this large now body of law in terms of the advanced rulings that have come through, and one finds that in the audits, and I'm going to talk about audits in a minute, several of the issues which have been litigated in advanced rulings are the same points that are actually coming up in the audits. So I think from an awareness point of view, it forms a very useful repository in terms of what the key issues are, so that one can actually take sort of suitable safeguard action, get contracts right, get the tax rates right, things like that. So maybe an unintended use, but it's a very sort of useful application of the advanced ruling process.
Thanks.
So I'll move over now to GST audits, and this is, I think, been a point of concern for several companies. Unlike the earlier indirect taxes, where we didn't have provisions on, arrest, we didn't have sort of provisions on provisional attachment, things like this. In GST, several of these provisions have been introduced. I'm going to break this discussion into 4 or 5 parts. So we'll start with audits, and then move into sort of the more serious actions that get taken place in terms of visitation of businesses by the tax department. So the audits actually are just of 2 types. We have audits by the tax authority on a risk-based selection criterion. I should mention that given that all of invoicing, return filing, and all of the data that gets generated in GST is online, there is a fairly advanced system that the tax authority is using to identify auditees, based on statistical parameters. And I'm going by the recent example of several audits that we've done. They actually have a ready question, sort of mapping your ratio of, for example, how much you imported vis-a-vis how much you sold, or what's your turnover of purchases versus your turnover of sales. Have you followed a consistent rate of tax between purchase and sale, things like that. So the regular audit is pretty straightforward. It's generally for a sort of 2 or 3 year period in terms of what audits we've seen so far. They come to your office, or they could call you to the government, to the department office, and it's really an exercise of verification of your records and returns. And it concludes with a report of findings. And if they think that tax is being missed out somewhere, then you'll get a notice for that unless you choose to make a voluntary payment. The GST law also includes a provision for special audits. Special audits are situations where we have issues where the department feels that tax is being missed, and it can ask the assessee to get themselves audited by a chartered accountant or a cost accountant. I want to talk now about some key concepts, or rather 2 key concepts on this issue of investigations. And the first is that several of GST offenses have sort of criminal law dimensions to them. Several of these provisions invoke the Code of Criminal Procedure. And while we've talked right from the time the GST law was introduced in terms of decriminalizing these offenses because they're ultimately economic offenses, and in several cases issues of interpretation, at this point in time, there's reluctance by the government to actually decriminalize them, and therefore several of these matters around investigations and recovery actions are going to court. Other key thing to note is that there is an assumption in one of the sections, section 135, which actually says that there's an assumption of culpable mental state, and actually it's for the assessee to prove to the contrary. And this mindset comes through in terms of the department interactions, and also in terms of the law. It actually shifts the burden therefore on the assessee to make sure everything's correctly documented, and there's nothing incriminating that can be found. So how documents are set up, what systems and processes are in place, all of that becomes very important. Now, moving to the powers of investigation, I'm now talking about the milder powers, which is inspection, and then the more serious situation of search and seizure. Now, inspection just simply means that an officer of GST who has a reason to believe, and of course there's a lot written on what the meaning of reasons to believe in. There's a whole body of law in terms of what that means. So if he needs to believe, or rather he needs to believe that there's been a suppression of transactions or an excess claim of tax, he can come over and make an inspection, a spot inspection at the office of the assessee, and go through the assessee's records to satisfy himself that no tax is actually being missed out. The search and seizure is, of course, a much more serious version of this. Again, an officer of Joint Commissioner rank. The nature of offense is different, so he needs to have reasons to believe that there's an offense which would make the goods liable for confiscation. Now, there's a separate section in terms of when goods become liable for confiscation. This is a leaf taken out of similar provisions that we have under the Customs Act. Now, if there is a search and seizure provision, what that means is an assessee could be visited by officers of the tax department. They will be asked to perhaps give statements. The tax department will make copies or take extracts or seize goods that they think are either incriminating or stuff that they want to refer to. And then there are provisions. There's a detailed circular actually in terms of what process they need to follow. So the fact that, for example, there has to be an authorization, there has to be a search warrant, there have to be witnesses. The process in terms of how the witnesses need to participate in the search and seizure, how documents need to be kept, which copies will be made available, and so on. And that's I'll come to, I think, what key takeaways are for businesses here. But it's very important, given that the incidence of these situations is on the rise. that there is awareness of how these are sort of put together. Now, I mentioned this issue of reason to believe, and we've had cases before the courts already where this distinction has been made between reason to believe and reason to suspect. And the takeaway here is that suspicion is not enough of a ground to trigger a certain seizure. There must actually be something beyond that, a higher burden of proof to actually trigger what reason to believe is. We then move to arrest, which is sort of the most draconian form in terms of the action that government can take, the department can take in terms of investigation actions. What we have here, again, the same concept of reason to believe. We now need this decision to be taken at the level of the commissioner. So when it came to investigations in terms of certain seizure, that was at the joint commissioner level. Investigations where there's power to arrest is at the commissioner level. And he needs to have reason to believe that the 4 offenses that you see on the screen, so offenses of that seriousness, have actually occurred. So the first is that there's been a supply without issuance of an invoice with intent to evade tax. The second is the sort of flip side of it, which is that there's been issuance of an invoice when actually there's no underlying transaction, which is enabling a wrongful availment or a wrongful passing over of credit. The third is that benefit arising out of these aforesaid actions have taken place, and the fourth is that tax has been collected from the customer but not being paid over to the government. Now, on a plain reading of these do look like sort of fairly serious offenses, but the challenge and the fear actually comes out of the fact that bona fide innocuous action can also through a certain lens be actually made to look like it's a transaction of this type. So take the first sort of situation, supply of goods without an invoice, and go back to the point I made earlier about a deemed supply transaction between 2 offices of the same entity, one in state A and one in state B. If you don't make the cross charge, and that is sort of seen by the department to be a supply without raising of an invoice, they could take a view there that you've actually, there's been a lapse in terms of the first transaction. The flip side, if you do make a cross charge, they could see that as a cross charge being without actual basis. There's no substance to that transaction, and therefore to take a view that it's an incorrect issuance of an invoice, and again sort of triggering this provision. And the last I'll talk about is this collection of an amount but not depositing it. Now, take for example contracts where you have a tax inclusive price which has been charged. So all that your contract says is that whatever amount is being raised on the invoice is a tax inclusive invoice. Of course, this will typically be a situation where you have a customer who isn't taking a tax credit. Now, the question is, how does one understand this situation of a tax inclusive amount? Does it mean that the tax has been collected? Because then if you take a view that yours was a non-taxable transaction and that it was just out of abundant caution that your contract mentioned that taxes as applicable would be inclusive, then if the government department were to take a view that there actually therefore is a deemed collection of tax in this inclusive tax invoice, it could potentially trigger this allegation that you actually charged and collected an amount of tax and not paid it over. Now, there is a difference in when one looks at the arrest provisions between cognizable and non-bailable offences and sort of the bailable offence, and the threshold for that is 50 million. That's 5 crore rupees. If that's the amount of the wrongdoing, then that would sort of move the offence over from being a bailable offence to a cognizable and non-bailable offence. Bail, of course, means that you come out of judicial custody. If it's a bailable offence, you get that bail for the asking. It's just about making an immediate payment and getting released from the custody. But of course, if it's an amount over 5 crores and it's a non-bailable offence, then one will have to go before a magistrate and follow the sort of criminal procedure code in terms of how bail gets granted. And that's where sort of GST takes on a very criminal law sort of view. The last bit on how these investigations take place is about summons. Now, these summons proceedings could get triggered during any form of the investigation. So it could happen when you're visited by the officer. It could happen when there's a search and seizure, and of course it will certainly happen in a situation where there's arrest, when they're collecting evidence. Now, evidence is collected through the summons process in GST as in other indirect taxes. And typically the summons notice will mention that it invokes the powers of the CRPC to say that non-compliance with the summons or furnishing false evidence under the summons would actually lead to serious imprisonment consequences. Now, from case law on summons, there are some takeaways, just some points to note that anyone can be summoned. It's not just an officer of the company. It could be, it could be a vendor, it could be a customer. There are some ground rules. They aren't necessarily followed, but it's just useful to keep these in mind, because if things go completely out of line in terms of the action being taken, then these are, some pushback can be ordered. So, for example, if there's an arbitrary exercise of power happening during the summons, or if it's happening sort of late into the night, happening on holidays, coercive action being taken and things like that. Now, important to mention that the statement given during the summons forms the basis of evidence for the notice that will inevitably follow. And therefore, there are two key defenses to keep in mind here. One is that if there's been any sort of coercive action in terms of giving the statement, it's important to retract that straight away. It's also important that if there is a person giving a statement which is sort of against you, it's possible to cross-examine that person in subsequent proceedings as a witness. Quickly talk about director liability. I just want to mention that the GST provisions do impose liability on directors, which of course they can come out of if they can prove, and again the onus falls back on them to say that the offence was committed without their knowledge, and that they've taken necessary steps, that there's been a discharge of due diligence on their side to make sure that an event of this type doesn't happen. So again, important to have manuals, processes, systems in place, a documented sort of SOP for most things around indirect tax, to make sure that liabilities to directors or sort of their personal liability is suitably ring-fenced. I also want to just touch upon this aspect of a private company, where it says that if the tax is not collected from the private company, then as opposed to a public company, for a private company, the directors become personally liable on a joint and several basis. Last point on this, therefore, is what should companies be doing? How do you protect yourself against sort of this sort of action being taken? And it's really 3 or 4 prongs to the strategy. It needs training. It needs sort of sensitization in terms of what the rights and obligations of parties are. How do you make sure you can trigger a retraction if that's needed right away? What are the situations in which you can challenge these proceedings in writ? And then, of course, it's also useful to perhaps get a sort of 4-eye test in terms of what your tax positions are, what your tax treatment of transactions is, how you're documenting your transactions to make sure that you have the best defense possible in place. And given that GST has become a sort of ecosystem-based tax, for example, take the simplest case, that if you have a vendor who doesn't upload his invoice and therefore denies your credit, you're actually going to suffer for that lack of credit. First, in terms of sort of the monetary consequence of losing the credit, but also potentially in terms of penal consequences that could follow, and therefore due diligence of the vendor system becomes quite important.
Udayan, this is a fascinating topic for me, and we are unfortunately running short on time. We only have about 10 minutes to go. I had 2 very, very quick questions because of the importance of this topic. What are some practical guidance for our colleagues in the audience to prepare in the event of one of these raids? And second is, can a lawyer be present? Meaning, can the company wait or ask the inspectors to wait until their lawyers arrive?
Right. So Paco, I think the key to handling these, I think is awareness and preparation. So we're doing a fair amount of work, helping clients with putting these processes in place, sort of dawn raid process, if you will, to say that this is the sort of steps you need to follow. One of our clients actually had, they had their PR team on standby as well, saying that if something like this comes, we're a listed company. Is this going to make the news tomorrow? Does this need to be intimated to the stock exchange? Right down to that level of detail. So it's really about awareness and preparation in terms of how best to deal with it, because this is an evolving body of law otherwise, and assessees are pushing back given how draconian these provisions are. On your second question about can a lawyer be present, yes. Starting from some customs cases, and now that's moving across indirect taxes, you can ask for a lawyer to be present, certainly when a statement's being taken. In fact, that's the origin of how the lawyer presence piece began. The working rule is that the lawyer can be physically present, he can be sort of visually available, but not within earshot. So he shouldn't be able to hear what you're saying, and he's not allowed to actually intervene or sort of interfere in the proceedings, but he can just be there to make sure no coercive action beyond the point is being taken, or no third degree as we call it.
All right, thank you, Dan. And we only have about 9 minutes left, so we got to run through a couple of things quickly.
So I'm going to, yeah, I think we're a bit behind. I'm just going to talk about maybe just the headline ideas in terms of some risk management and cash accretion, how we're helping clients save tax, and it's really arising out of how the provisions are read that these opportunities arise. So I think, given the lack of time, maybe I'll just stick to the headline points. The first is what's the best contractual terms that you should enter into, especially for more complex contracts, things like EPC and so on. Should you split your contract? Should you use multiple entities? How do you make sure that they are properly documented in terms of composite or mixed supplies? The second set of ideas is around liquidating credits which might accumulate. So again, going back to the point that each of your presences in the different states is deemed to be rather treated as a different tax entity, you could end up having a credit accumulation in one place. And we have a bunch of strategies around helping companies liquidate that credit. Two key ideas around that is how they value stock transfers, goods and services as they move from one entity, one deemed separate entity, to the other. And the second is how to actually reduce the taxes you pay on procurement and thereby reduce the accumulation that will inevitably follow otherwise. Linked to sort of not allowing credit to accumulate is to making sure we minimize how much credit gets reversed on exempt transactions and because suppliers are defaulted. The last bit on saving cash is to deal with your litigations in the best way possible. One key defense of late has been actually questioning, successfully questioning in terms of the powers of the authority to actually levy a notice or rather issue a notice. So this whole issue around jurisdiction of the demand of notice, several sort of demands have been quelled on those lines. Then talking a little bit about on the larger customs and supply chain piece, it's not strictly GST, but given that customs is an inherent part, there's a distinct overlap now for cross-border transactions. I just wanted to mention the AEO certification, which several procedural relaxations can be enabled through it. Self-certification of certificates of origin. So basically, there's 3 tiers under the AEO certification that you can get. Saves both money as well as time in terms of customs processes that follow. On the risk management side, I wanted to talk also about any declarations that people have made under the special valuation branch. That's the customs department, which deals with transfer pricing and on the goods side, where changes might have been made on account of COVID-19 related pricing changes. So we've been working with clients where transfer pricing policies have changed because of changes in profitability and what implications that might have for customs valuation. The last bit around customs is also to do with free trade agreements and the new rules that came out in 2020, what we call Carota, the rules regarding how rules of origin are to be determined. I'll just leave the thought with you that there's a much higher burden on the importer to make sure that these rules are being properly followed, that due information has been collected from the exporter to make sure that the certificates of origin actually qualify to get the concessional rate of customs duty.
Dan, very quickly on this point, do you have any tips on cash accretion, which I guess is a fancy way of saying saving money or earning money?
So, Paco, as I said, it's really about minimizing your tax cost and liquidating tax credit if you have any. I'd say that the best time to look at those is if you're going through a phase of capital expansion and you're going to have all of these assets come through. Important to sort of nicely segregate which assets you're going to be able to take, or which expenses you're going to be able to take credit and which not. So I think CapEx space is one. Contract reviews overall is a good way to protect risk as well as make sure maximum credits come through, and also pre-audit preparation, because if some wrongdoing is found through the audit, you're going to pay that much more interest and potentially penalty. So saving money through doing that as well.
Thank you.
Coming to recent developments, I just want to talk about some matters which have made sort of the Supreme Court now how you interpret rate classifications. There have been cases here. I just want to leave you with the point that on a case-to-case basis, the Supreme Court has sometimes looked at purpose of interpretation over strict interpretation. At times they've gone on the end use. So getting classification right and being able to apply the correct rate of GST is really becoming quite important. And obviously, GST is a top-line based tax. It's not linked to profits, and therefore, the consequence of getting a top-line based tax wrong is that potentially the entire profit margin could come out of the tax which is wrong. The other piece is the interplay between the customs tariff and the GST rates. Now, I just want to mention this is quite important. The fact that we don't actually have a separate GST rate schedule as such in the manner that we have the customs tariff. So the customs tariff is aligned to the HSN, and you have the chapters, you have the sections under that, and literally each and every item, as we know for customs, has a particular. In India, we follow the 8-digit classification, and right down to the 8-digit, we have rules in terms of how an item is to be classified under that. For GST purposes, we've followed the principles of the customs, customs tariff and interpretation of entries, but not fully, and therefore a lot of the disputes that we are seeing, emerging disputes in areas such as in the renewable energy sector, some items, as well as most recently, fruit drink based beverages. These are all items. The fact that there's not complete alignment between the GST rate entries and the custom entries, I would mark as a point of significant risk, because it's not just about getting classification right, but it's also being able to see the correct description in the GST rate through the lens that customs is going to see it. The GST authority is going to see it, and the fact that you might need to refer to other legislations for the entries in terms of what your defense to the correct classification and the correct rate might be. Some other recent developments around different business models. So on liaison offices, we've had clarification that they don't need to register for GST. There were litigations on that. I talked about intermediary services before. We had a recent clarification explaining what intermediary services is, but it actually, as I said, like in several other clarifications, stopped short of answering the key question of where does marketing services stop and sales services start, as we understand them for transfer pricing, because sales services are intermediary services and will give rise to a GST tax levy in India. Marketing services will not, and therefore, getting contracts right and contract structures right in this context of intermediary becomes quite important. We also had the GST ruling on inverted duty structure, where the Supreme Court held that it was a matter of policy that the service element in the inverted duty structure could not actually be given back. One hopes that the government or the parliament will actually change that provision, but for now, this is how the Supreme Court has ruled, saying that interpretation can't override policy. That takes me to the last section, which is just a couple of points on issues that some of our US-based clients are actually facing. The first is on this treatment of discounts. Now, as you know, discounts which are given post facto are not deductible for GST purposes. What we've actually had is an advance ruling, which was then upheld by the Appellate Advance Ruling Authority to say that a post facto discount could actually be seen as a subsidy. So, for example, if A sells to B and then B sells onward to C, and A gives a post facto discount to B, then that post facto discount is actually being seen as a subsidy for the price that B charges to C. Now, we're actually in the High Court on this issue, but I just wanted to mention it. It's how discounts are structured and how they're documented is becoming an emerging area of dispute. There was a positive clarification in terms of export of service to say that transactions between separate legal entities, as opposed to branch and head office, will actually qualify for export of services. So for those of you who have actually faced that litigation, that's a clarification which you can use. I spoke a little bit about IP before, the issue of transfer of trademark as well as import of trademark. I just wanted to mention it got resolved in the last rate change, but otherwise there was this rate arbitrage between, trademark agreements which were taxed at 12% and franchise agreements which were taxed at 18%. And what we were finding was that the tax department was seeking to take pretty much every type of IP arrangement as a franchise arrangement to seek to levy the higher tax. That problem, of course, has gone away with the rate for trademarks also being increased to 18%. But for the last 4 years, there could be litigations on this. And the last is an emerging controversy on one element of customs duty, which is the social welfare surcharge. That's actually a set of notices which the customs department has started issuing as recently as in October this year. The issue there is that if the basic customs duty is exempted, then should the social welfare surcharge, which actually sits on top of the customs duty, be exempted also? Or should it be sort of a deemed value for SWS continue to be calculated even though the basic customs duty is not being charged? So several of you might have received notices on these and are in the process of replying for them. We believe there's of course a good case to defend that the SWS is not payable if the basic duty is exempt. Pakub, sorry I've been a bit over, but back to you.
Udayan, that was a brilliant presentation. You covered a huge amount of information in very, very clear detail, and I think all of us really appreciate it. We don't have time for audience questions, but your contact details are there, including your email address, so please feel free to send Udayan any questions that you might have. I do have one question that I'm going to ask you in 15 seconds or less. What's the one takeaway that you want our audience to remember if they remember nothing else?
Well, I'd say that GST has become a minefield. The simplicity that we were hoping to see when it came in 2017 is sorely lacking. But I think there's enough body of law from the past to put good defenses in place and to still find avenues for optimization. So it's about looking at it with a microscope and finding the right answers.
Okay, thank you so much, Udayan. And on behalf of Udayan and myself and Ketan and Co., we really want to thank the audience for attending today's session. There's a lot of stuff, and Udayan covered it superbly. We also would like to thank you for your participation, and also to my dear friend Amy Hariani and the U.S.-India Business Council. Amy, I don't know if you have any final words to say, but thanks, everybody.
No, thank you. Thanks, everyone, for your partnership and a great program. Look forward to working with you all on this, taking it forward.
Okay. All right, take care, everybody.